Good morning, ladies and gentlemen, and welcome back to your morning market update with your professor. Today is Saturday, June 13th, 2020. I already shared my morning market update where I provide updates on what we call our big four indices, meaning crude, the US dollar, the bond market, and the euro, and a number of other key indicators. But what I also shared this morning on the blog is a copy of this document. This is a document I just received yesterday from a colleague of mine, and it's a very recent survey of Fortune 500 CEOs from all around the world. And essentially what they've done in one short document is capture what their expectations are going out over the next couple years, perhaps 2 to 5 years out. And the reason I want us to spend some time thinking about this or looking at this document is to enable us position ourselves both at an individual level, at a corporate level, and also just as importantly from an investment perspective. How should we be looking at this crisis and, of course, the recovery and the opportunities that will ultimately follow? And I think that's what I hope we can take away after or upon the review of this very, very short document. Now, what I've also done to facilitate this conversation is to make my own notes, as I always do. I've gone through the document and I've sort of highlighted a number of things. So, I mean, there's a lot of things on here. I don't think they're all relevant to this conversation, but what I've done is essentially to shortlist or to curate a list of about 12 items, a dozen items or so, things that I think we should think about going forward. So without further ado, I'm just going to go straight into it, and we'll start with number one. The survey essentially asks all the CEOs when they see the economy returning to full potential. And when the economists mean full potential, they mean when do they see the economy returning to levels leading to the recession or to the crisis, meaning perhaps 4Q 2013 numbers or full year 2013 numbers. And about 52% of them, 52.5% to be specific, suggested that we probably won't see that level of activity till the first quarter of 2002. Now, this goes in line with what I've been saying. And for those of you on the blog, you will know that I have been adamant about this called V recovery situation that is being bandied around the media and newspapers. I just never saw it, and I think even prior to COVID, there was a pre-existing condition. The economy had a pre-existing condition. It was not only overdue for a pullback, but given the amount of leverage and credit that have been injected into the system or that was needed to essentially to generate growth, to fuel what we now know as the longest expansion in U.S. history, meaning 2009 all the way to 2019. A lot of that expansion was fueled by credit, by money supplied by the Federal Reserve Bank or the central banks for that matter. And so, we can go into that, and there's so many different ways to cut it. Corporate earnings, for instance, came mostly from a lot of leverage. And even with that, the growth in earnings was steadily declining. And it goes back to something that I always talk about, which is the impact of credit or sort of the diminishing returns of debt. At a certain point, once you start to create leverage in a system, be it a company or the country at the federal or the state level, the returns on that debt start to diminish at a certain point. I used an example in my last video comparing growth or GDP or debt to GDP. And it's on record. There's a book I have on here written by A. Gary Schiller, PhD. It's called The Age of Deleveraging. And a number of research papers out there show that after 90% debt to GDP, growth slows down to below 1%. And beyond that, it even compresses further. And this is why countries like Italy, which carries about 146% debt to GDP, aren't going anywhere soon. Same as Japan. Japan is carrying, about 220% debt to GDP. Fortunately for it, it's an export-driven economy, so it's able to maintain very solid current accounts, and with that, something that seems like a healthy economy. But essentially, Japan hasn't grown from an output standpoint, for the last 30 years or so. So that's that. I think that it's very clear from an economic standpoint that we have a long road ahead here, and with all the leverage in the system and the additional stimulus that's been needed to dig us out of this hole, it's going to be a while before we return or before we close the output gap. And here, the CEOs are suggesting that it's probably as far out as first quarter of 2022. So that's that. Now, let's move on to the next. It says, when will 90% of your workforce return? 26% of the surveyed CEOs said never. Ain't never going to happen. So, right there, we're looking at persistent structural unemployment going forward. Structural unemployment, which means that there are going to be people who are going to be, at least in the formal sense of employment, be permanently unemployed. So that's probably going to spawn new opportunities or a new area for gig workers or what have you. But it's very clear that we're going to have, going forward, a sustained level of structural unemployment. And then obviously the other, 50% or so, or 75% that go back to work, that's going to take a while to work them back into the workforce. And there are a number of estimates here going anywhere from sort of 3, 4, 5, 6, even up to 10 years before we achieve maximum employment, as we had in February 2019, leading into the crisis. So that's that. Now, let's move on to the third point. The question is, when will business travel return? 52% of the CEOs said never. Ain't never going to happen. So essentially, a lot of business interactions will now be done remotely. 50% is a lot, or 52%. Some of them suggest, 25% of them suggest that business travel will not even return till 2022. So that's 25%. So between 2022 Q1 and never, you've got 78%, almost 80% of CEOs saying business travel is pretty much as good as dead. It's basically ancient history. Now, what does that tell us? It basically tells us that we have to learn how to work remotely. You have to learn how to generate income remotely. If you're a corporate foot soldier, you really need to sort of step it up and figure out how to make your mark, without doing quote unquote eye service, as we used to call it when I was in military school. The days of just essentially freeloading and just appearing to be busy in the office, those days are gone. It's over, not coming back. So I think that, this is a time for individual skill to shine, and there's really nowhere to hide if you have nothing to offer. So that's that. Number 4, layoffs. The question was, how many of you laid off workers? 48% of the CEOs says none. Now, that's really hard to believe, obviously, but clearly nobody wants to appear to be the leprechaun here. So, of course, they're going to say no. However, 10% of them said they laid off more than 10% of the staff. Sort of 10% said they laid off 23%, and about sort of 5%, 20% of them said they laid off 5% of staff. So that's that. The fifth question was tech transformation. How do they think technology is going to transform the way we live and the way we function and the way we earn a living? And that was a very, very resounding 75%. 75% of these CEOs believe, in fact, that we've entered a new era or age where essentially technology is going to drive everything. So again, we go back to item number 3, business travel. That's out of the window. So remote working or remote productivity is the way forward, and that's going to be facilitated essentially by technology. So this is going to be a major opportunity for a lot of tech companies. You're already seeing some of it out there. Teleconferencing facilities and other middle office or sort of back room operations or companies that provide infrastructure for remote communications, remote delivery systems, and just remote working. So, tech is going to be, as we all know, a major area for growth and investment opportunity. Now, the sixth question was regarding wages, workers' wages. 50% of them saw a decline, a major cut in wages. Okay, now this is a very sensitive one, and it goes back to my central thesis. If you've been following my blog, you, of course, understand that I'm a major believer in deflation, or in a secular deflation. Now, what is deflation? Deflation, there's different types of deflation, but here we're talking about price and asset deflation. Price deflation obviously includes employment or sort of wages, right? And asset deflation includes sort of other things like real estate, real assets, and so on and so forth. Clearly, even before this COVID crisis, I've always believed that the world has sort of turned, or sort of we turned the corner, especially after 2008, 2009, that we were in a deflationary environment. Again, we could go off on a tangent on this, talking about inflation versus deflation. There are those who've been chanting deflation or inflation because of the amount of money, essentially the amount of stimulus or activity by the central banks in the last 10 years, essentially quantitative easing, whether it's QE or essentially suppressing interest rates in order to sort of increase credit or money supply and then credit. There are those who've been screaming, especially sound money evangelists about how we're going to become Zimbabwe and so on and so forth. But, like the Fed chairman said the other day, we look at the numbers and we don't see inflation anywhere. So we have to ask ourselves, what kind of environment are we going into? Clearly, there's a deflationary force there, just basic products from China and Southeast Asia, for instance, have kept the cost of goods down significantly. And that inflation or that deflation has been exported to the rest of the world. Now, what we're seeing is that also there's going to be a deflation in wages. So I think even before the COVID crisis, you were seeing a slowdown. There were just very, very, very minimal gains in wage growth. So what you're going to see with this COVID or post-COVID world is that essentially with the destruction or sort of with the contraction of capacity, obviously you're going to see a contraction, the contraction in need for labor. And when there's more labor, when there's more supply of labor than demand for it, obviously, what happens is that, wages are going to come down. So I think that's what they're saying there. Number 7, capital spending. When do they see capital spending return to 2019 levels? Varying estimates that, some say 19% of them say 2020, 36% of them say 2021, 28% of them say 2022, and 13% 23. Again, that's just one of those areas where I think it's more sort of, it's a driver for economic activity, but I think it's not something, it's sort of a second phase issue or problem. Now, number 8, the question was, what is the single most important thing or lesson you've learned from the COVID crisis? And basically, the unanimous response was working from home works. So it takes us again back to number 3 and number 5, business travel and tech transformation. I think there's going to be a lot of new efficiencies squeezed out of systems. Clearly, when you go to the income statement of these companies, you're going to first look at labor, right? Look at sort of like the payroll line. that line is going to sort of shrink significantly, and I think a lot of corporate profits going forward are going to be driven from this contraction on that single line item payroll on the income statement. So working from home works, and I think they've really made a massive note of that. So you can expect them to bear that in mind when it comes to rehiring. That also is not a very, very good omen in terms of time to achieving full employment. I think a lot of CEOs are going to sort of like bide their time and make sure that they're onboarding new staff based on actual demands and a need. Number 9, which country or region will lead investment opportunities coming out of this recession or coming out of this crisis? Overwhelmingly, 75% of them say the United States. Now, I've always sort of said that myself. I don't think there's very much of a doubt there. A lot of folks have come out and said, oh, China is going to lead the recovery. And my response is always, China is an export-driven economy. It's essentially hooked on exports. And who consumes those exports? The U.S., for the most part, and the EU, of course. But a lot of the consumption for China's production comes from the U.S. And so if the U.S. doesn't consume, guess what? China doesn't produce. It's that simple. China's local consumption economy, or sort of at least as a percentage of its GDP, remains quite low. I mean, it's come a long way over the last 20, 30 years or thereabout, but the per capita income and spending is still a trifle compared to the United States. So I don't see China leading us out of this downturn, certainly not from a consumption standpoint. So that's that. Top 3 investment picks, top 3 investment stocks or picks. Again, this is, I guess even a kindergarten kid would sort of provide the same answer. They answered or they responded, Amazon, Microsoft, and Apple. I'm not going to spend time there because that is pretty much trite. That is saying the obvious. Number 11, top 3 CEOs. They voted Jamie Dimon of JP Morgan, Macmillan of Walmart, and Satya Nadella of Microsoft. Top 3 stocks to short, Tesla. Well, for obvious reasons, it's probably, some would say, sort of beyond overvalued. But again, that's just sort of, that I haven't done any analysis on Tesla. I don't own it. I haven't really looked at it. So that is their consensus, is that Tesla they would short, not because it is not the future, but even if you have to buy into the future, it has to be bought at a reasonable price. So the next short on their list was Carnival Cruise Line. Well, I mean, a lot of day traders have been feasting on that, and I think what they're saying is it's cruise travel is not coming back in a hurry, and the stock is probably about overvalued right now. The third, which was a bit more surprising, was Boeing. Now, we all know that Boeing has its problems. They may not be going away any day now, but I think being a duopoly, meaning sort of Boeing and Airbus are the only large-scale commercial airline producers in the world, Boeing will probably be fine in the long run, but it's probably got a good 12 to 24 months of digging out of a hole here. So, haven't really looked at the valuations, but it's been very heavily traded by day traders. So I can imagine there's probably a lot of noise in the stock there. So that's it as far as the Q&A, or sort of as far as the questions on this survey goes. Now, I think what I really want us to think about is how do you position yourself over the next 5 years? That's probably the more critical thing. The first, the dozen points I made earlier were just sort of what I call the summary indicators. But the question is, what do you now do with it? What do I do with this information? And what I've done is I've broken it down into 3 parts: individual skill versus corporate foot soldier, And I made a remark there suggesting, listen, there's no more freeloading. The days of just sort of putting on a tie and a coat and just showing up in the office and shuffling around pieces of paper for 8 hours or 9 hours, I mean, those days are gone. They're just never coming back. So productivity definitely is going to be washed, and you better make sure that you've got the goods and that you can deliver them remotely. Two, the second point I made was the role of technology. You have to learn how to generate income remotely, and this ties back into number one. There is really nowhere to hide anymore, so I think a lot of us are going to have to up our skills or polish up our skills, especially our ability to communicate our value remotely. This is going to be really, really, really key. It's a lesson I have had to learn and still learning myself. It's one thing to have the goods or to have sort of the skill or the knowledge or the product. It's quite another thing to communicate the value of that product remotely, especially through new media to your audience or to your marketplace or to your customer base. So I think this is going to be a major opportunity, learning opportunity for most of us, and that's about that. The third part is investment philosophy. I think this is probably the one that a lot of people are waiting for, and probably the most critical. Now, one has to choose or sort of pick the way they want to sort of see the future from here on out. There are those who say, we're still in a growth environment and forget about it. This is just a hiccup, and we're just going to get back on the bus and just go back to the high-flying days. And that's well and good. That's their opinion. I have a completely different view. I have been a student of deflation for 10 years now. I've been studying deflation since 2009 or 2010. I've read several texts on it, several research papers. And if you look at where we are in the credit cycle, right, or sort of in the monetary cycle, and I've gone all the way far back, sort of even the pre-dollar era, pre-gold era, and all of that stuff. And you can see we sort of come through a full monetary cycle where the ability for the system to expand is now being, or sort of growth or output to expand at a global level. It's being limited by the amount of debt and credit in the system. It's just ridiculous. We have globally about 350 trillion worth of debt in the system. No, I take that back. We have about 260 trillion worth of debt in the system. And total global asset values is about 350 or so trillion, everything all combined. So that means the equity in the system is probably about 80 to 90 trillion, and then the rest of it is debt. That is high. That is a high amount of leverage. Now, when you have a contraction like this, obviously, a lot of that value has come down and will continue to come down. So that debt is not going anywhere. It's going to sit there, right? So equity as a percentage of sort of global asset value is going to necessarily have to shrink considerably. And with that shrinkage, it's going to come, which is deflation, it's going to come a compression in asset values. So, there's no getting around it. I mean, the numbers are there, the facts are there. You can argue all you want till you turn blue in the face. You can argue with numbers. So I think that looking forward here, we're going into a period where that debt must necessarily have to shrink. It necessarily has to shrink for us to get back into anything that resembles true and real economic growth. And this doesn't happen overnight. You don't deflate the debt bubble in 2 weeks. You don't bring in the feds and, they just essentially pour money on the streets and then we're back to growth. No, these things take a while. So I think we're going, even before the COVID, we were due for a moment of truth, going through this period where this debt cycle resets with the beginning of debt deflation and asset deflation, obviously commensurate asset deflation. So I think that is one overall way, or sort of that is the global or sort of the macro picture there. Now you have to ask yourself, how do I play this macro picture as an investor? What type of investment, what kind of opportunity should I be looking at in an era of asset deflation? And I think the answer is simple. This whirlwind is probably going to take everything down with it. And it becomes a question of, it's a war of attrition. What boats do I get into that is not sinking as fast as the others and that may have a chance of floating when this 1,000-year flood comes through? And I think that's just a perfect analogy. You have to look at asset classes that allow you to essentially preserve capital. It just means that growth, the days of just sort of expecting, 20% returns year on year for equity, those days are gone. They're not coming back for quite a while. So I think we have to, first of all, adjust our mindset that, equity returns definitely are going to have to shrink considerably. So, investing in this era is going to be more about capital preservation and income. Because in a deflationary environment, cash is very, very valuable. So you want assets, essentially, that are going to be throwing out cash, right? Because as deflation occurs, cash has more buying power. So you want to make sure that whatever you're investing in, has the ability to generate cash, which gives you that right or that optionality to act on opportunities as they arise. So you have to think about dividend producing or dividend yielding assets, like financial assets or any other kind of assets. If it's real estate, if you can find renters, commercial real estate is a disaster. Maybe residential, because people still need a place to live, or other sorts of income generating real assets. But I think that's going to be the key over the next 5 years. Growth, definitely. There are going to be a few companies or growth companies that will do well, but I think for the most part, we have to pare back our expectations there and sort of focus over the next 2-3 years on things that preserve capital. So that's about it. I don't want to make this too long. We're at the 27-minute mark. I try to keep these things under half an hour. We've gone through a lot of things here, starting from the survey and essentially a top 3 question or top 3 list of questions that I've drafted to provide food for thought for you. So that's about it. I'm going to wrap it up here. It's the weekend here. Saturday. It's been one hell of a week. Markets have been absolutely stunning. Or sort of some have been stunned by it. Yesterday's session was particularly dramatic, watching the Dow go all the way to 1,000 points and track back to -50, only to be saved by the bell, literally. It was sort of at about a half hour to the end of trading mark before, the Dow and other indices recovered miraculously from very, very low, from their lows of the day to close out at about 1% or so. So I think we can expect to see this kind of volatility over the next few sessions. The key there being that this whole idea of a V has been completely disabused. I think if anybody's still sort of thinking there's anything such as a V recovery, they need to have their heads examined. The Fed came out 3-4 days ago and said, listen, this is going to be a long slog. It's not going to be an overnight flip the coin and we're back to 2019. No, not going to happen. So they even presented their numbers and their estimates for growth going forward. So I think that's a very, very sobering thing. This market clearly had gotten way, 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 way ahead of itself. So I think what you're seeing in the market over the last 2-3 years is essentially a repricing of risk or a repricing of expectations. Not so much risk, but a repricing of expectations. So those who were essentially using, aggressive Q3, Q4 earnings estimates are going to need to sort of push those numbers far back out, and we're going to see how those new numbers are going to reflect in new asset values. So strap on your seatbelts. I think sort of the next few trading sessions, maybe even weeks, are going to be pretty volatile. But I think after 3 or 4 weeks, especially going into earnings seasons, things should settle a little bit, and I think we should have a clearer view of what the mid or near to midterm prospects are for the markets in general. So that's it from the professor. Thank you for watching, spending this half hour with me, and please continue to read the blog or to follow the blog. And if you have any questions on any of these points, especially the latter part of my presentation, please feel free to ask questions on the blog, and I'm always available to respond to these questions. Thank you, ladies and gentlemen, and enjoy your weekend. Goodbye.